as well. That will be sent to you in an email. There'll be links contained therein where you can watch again and match it up to the slide deck as well. I have disabled the microphones, but we will take that restriction off at the end of the session. So if you have any questions, please, during the course of the presentation, if you'd like to jot them down in the Q&A box, which is along the top of your screen, pop them into the Q&A box and we can have a sweep of those at the end. And also, I'll take the restriction off microphone. So if you'd like to put your hand in the air, we'll come to you accordingly, and you can ask your questions of my colleagues on this call today. So that's the housekeeping out of the way. It gives me great pleasure to announce the two presenters for today's session. They are Kim Calico and Sunil Arora. Kim is the Executive Director of International Affairs at Baker Tilly, where she helps guide the strategic initiatives of the firm, including new market opportunities and visibility, and managing key strategic relationships. Kim's a strategist and business development professional with around 20 years experience in international business and business strategy, and she's executed projects across industries from financial services and technology to energy, automobiles, defence, aerospace and manufacturing. So a very good morning, good afternoon to you, Kim. And Kim's joined by her colleague Sunil Arora, who is a tax professional with over 25 years experience in issues related to direct and indirect taxation. Sunil is the National Head of Taxation at ASA and Associates, and he's advised mid to large global conglomerates on the business and investment structuring, tax due diligences, not easy to say for me, complex holding structures, global transfer pricing arrangements, expatriate mobility solutions, and he has successfully represented before various tax and appellate bodies. So a very good morning to both of you. I know it's good afternoon where you are in the world. So Kim, I'll hand across to you straight away.
Thank you so much. Good morning, everyone. So I'm going to just dive right in because we have an hour and this is a huge area. So this is a very interesting slide. We call it India and the world, but essentially it talks about, so if you look at the little countries that have been highlighted in the image at the back, this is where India has trade agreements of some sort or the other. Now, why India? Huge consumption market, one of the fastest growing markets, the fastest growing market in the world right now. A lot of increased capital expenditure by the government, which in turn has this knockdown economic effect on pretty much every sector. We're building more roads, highways, railways, metros, airports, seaports, river ports, everything. We're in a geopolitical sweet spot. And this is for electronics manufacturing, for space launches, for aviation, for development of artificial intelligence, for technology development, stuff like that. A lot of large firms are setting up their R&D divisions in India just because of the sheer number of English-speaking trained scientists that we have here. Another thing that many people may not know about is the digital public infrastructure system. India's public services have been digitized. We digitized around the time of COVID and it kind of went on steroids after that. So we have our financial systems. We've got something called BharatNet. We've got the Aadhaar systems. We've got DigiLocker, Jan Dhan Yojana. Everything is running on a digital platform in India. So when you travel to India, you don't necessarily need cash. If you have a UPI ID, you can just pay from your phone. Going down to the strong linkages and strong integration and trade linkages that we have with the rest of the world, we have signed a number of trade treaties, and these cover goods, these cover services. Each of these have a little clause called rules of origin. We'll come to that later. But effectively, if you meet those rules of origin requirements, which means manufacturing in India, or a certain percentage, usually about 30% of the value of the product is created in India. Depending on the trade agreement, you could access several of the existing trade agreements that India currently has. The India-Middle East, East Europe trade corridor is one of the key ones that is being developed right now for a lot of countries between, so the main targets here would be Marseille port in France. You've got Italy, you've got Greece. From Greece, from Athens, it goes all the way down to Haifa port in Israel and then through the UAE and into India. And this is being developed as a critical corridor by all of these countries, which could also impact the UK in a positive way because it just eases up the movement of products, goods and products through this channel. Now, if I was to move to the next one and we would look at the key structural reforms that have happened in India over the last 10 odd years, we've brought in GST. So we've simplified our indirect taxes. We've removed a whole lot of service taxes and sales taxes and everything and just simplified it with GST. We've brought in the insolvency and bankruptcy code, which makes it a lot simpler for you to close down entities in India right now. There's also a national monetization pipeline. This is effectively national projects, government projects that can be privatized for a certain period of time, run by private entities with a certain amount of rent being given to the government. And this allows the government to generate more revenue by monetizing its assets. Liberalization of foreign direct investment policies, faster import and export facilitation, Digital India, Gati Shakti, you can read all of this here. But what it has done is it has made it a lot easier for foreign companies and Indian companies to do business in India because it's just speeded up things. For example, the faster import and export facilitation. By digitizing systems at ports, you have made it so much simpler to just move product from outside the country through the country. So I'm going to move on to the next slide now. I thought it was important to talk about the mega projects for infrastructure development because in India, the moment, so consumption in rural India, and remember that we are 1.5 billion people. So you're talking about a huge chunk of our consumption because about 60% of our population lives in rural India. Consumption would increase the moment they had a good road. And everything was dependent on roads, electricity, water. So we've got electricity and water to all our households. Now we're getting roads in there. So to manage this sort of infrastructure development, because India is not a flat country, we have mountains, we have valleys, we have deserts, we have forests, jungles, everything. So we brought out something called Gati Shakti. Now, Gati Shakti, yes, there are big numbers thrown out over there, but basically it is a digital platform that helps every single ministry and every single state and government entity in the country coordinate with each other. So it brings out faster coordination and it removes the delays that you would have with moving files from one department to the other. What's happened because of that is we've been able to put up almost 100 new airports. We've been able to put up thousands of kilometers of railways and highways in record time. We are now putting up, I think, 40 kilometers of new railways every day or so. You have the National Infrastructure Pipeline. This was $1.4 trillion worth of outlay between 2020 and 2025, mainly focused on creating affordable assets across energy, roads, railways, ports in tier 2 and tier 3 cities. So essentially what's happening is all of the services that are offered in the metropolitan cities are now being offered elsewhere. It's being offered in tier 2 and tier 3 cities, which never really had access to this earlier. And the whole idea behind that is to reduce the, I've forgotten my words. It's basically to reduce all of the overcrowding and the migration towards the key metro cities in the country and have people stay in tier 2 and tier 3 cities. So you have this sort of democratic development that happens across the country rather than having the metro cities leagues ahead of the rest of the country and the rest of the country lagging behind. Then you got the national logistics policy. This is a very important one for anybody who's looking to move goods through the country. Historically, India has never had a consumption problem. We've always had a supply problem. It's always been very difficult to get your products to your customers. So what we did was, because logistics was so expensive, since most of our stuff relies on roads, we've started, and that meant a lot of diesel being used up. We've started bringing in rail, bringing in dedicated freight corridors, bringing in seaports, bringing in inland waterways, and developing all of this. So you get trucks off the roads and onto other alternative and less polluting options. So The target here is to reduce the logistics cost from, I think it's about 16% right now, to about 8% of GDP, and bring it even lower than that. Railway infrastructure, these are dedicated freight corridors. How are they different from normal freight corridors and normal freight movements on railways? The railway lines are wider and you have double stacking of containers. So it can take double the quantity of, it can effectively double the capacity of freight that is moved across the country. You have about 12,000 tons that they are looking at moving. And remember that we are electrifying a large chunk of our railways. So you're saving a huge amount of CO2 emissions just by moving product from roads and highways onto railways. Double the speeds, double stacking, et cetera, et cetera. And we've got new dedicated freight corridors planned. So it's not that the existing ones were thought of and then stopped. We've continued. Roads and highways, huge road network. This, I have to, full disclosure, the rate of new highways that are being set up is reducing because we've already met most of our targets. Right now, the focus is on maintenance. So anybody who's got road or highway maintenance equipment, this is a huge growing market for them because you've got hundreds, about 140 or 150,000 kilometers of national highways and high-speed corridors that now need maintenance and will need regular maintenance because these are the lifelines of our country, if you will. Toll has turned electronic. We've got, you can see the numbers here. It's a huge number of projects that are coming up across. And this is not just in the plains and the flat areas. This is also in the mountains. So, you can now move perishable goods from the mountains to the cities in under a day. So ports and shipping, another big one. We've got two plans within ports and shipping. So this is the Maritime India Vision 2030, which looks at increasing shipbuilding, port expansion, and hinterland connectivity. They studied ports in, I think, Rotterdam and in Germany, and like Hamburg port was one of the ports that were studied, and a few in the US to understand how these ports were being developed, how the land and customs and connectivity was developed. And they started replicating that in India in a smaller way. So we're looking at expanding our port capacity. For starters, we're starting with 6 mega port clusters, JNPT, and a few of the main ones form part of that. But effectively, there will be two, like JNPT and another one, Dola are going to be handling about 500 million tons per annum, while the other four will be 300 million tons per annum. For anyone who's been trading with India, this is a welcome change because earlier there used to be problems with deep draft ports in India. Sagarmala also has looked at about 500 plus projects across the country with $70 billion worth of investments to be completed by 2035. And effectively what all these projects are, if you look into the fine print, is it is modernizing infrastructure around the ports. And this is digital as well as physical infrastructure. Waterways, we're turning our rivers into waterways. 26 have been identified for cargo and passenger movement, 111 in total, but mostly for passenger movement. Multimodal logistics parks, this is also a very interesting one. There's a lot of Asian countries that have been taking advantage of this. 35 multimodal logistics parks planned across the country. About 15 of them are targeted for this year. Typically, there'll be about 100 acres and above. The important thing with this is a lot of our new cities that are being developed actually developed. So I'm talking about cities that exist today that were farms and jungles 20 years ago. Now, these new cities have developed from logistics parks. They started with industries setting up campuses in there. They started as logistics centers and logistics nodes, and then they developed into cities. The difference between these and organically developed cities is these end up being far better managed, far better organized than the normal overcrowded cities that many people associate with India. Key sectors. This is just projects that are under implementation, and you have it across renewable energy, across EVs, automotives, this is a huge one. Pharmaceuticals, also another huge one. We're currently 50% of global vaccines that are being produced and 8% of clinical trials. So we're planning to take this whole industry to about 130 billion US dollars by 2030. So there are investments in there. Legislation has been smoothened out. Taxes have been smoothened out. Electronics design and manufacturing has always been a huge thing for India, particularly for job creation. Semiconductors is the new thing that we're going after. Not so much fabrication, but more design and just assembly. Chemicals also very huge market, key market for a lot of UK exports into India. This too, we're looking at taking it up to about 383 billion by 2030. Digital services, we're huge. BharatNet has provided broadband to about 214,000 gram panchayats. Gram panchayats are local village level governing bodies. We've had about 1.2 million fiber to home connections that have come up in the last few years, and about 1 million Wi-Fi hotspots being planned, currently being installed across the country. What this means is if you have digital services and e-commerce, rural India now has access to all of that. Textiles, another huge area also targeted by the FTA. We're looking at growing our textile market to about $350 billion by 2030, with at least $100 billion of that from exports. Currently, and I was surprised when I saw these numbers, I did not realize that India was 95% of all hand-woven fabric in the world. And finally, health and well-being. In India, we have traditional medicine, which is Ayurveda. We also have homeopathy, and we have allopathy, which is the standard pharmaceuticals and stuff like that. However, it's very difficult to get doctors from the cities into the villages. So bringing healthcare to all of India was problematic. So there were a lot of innovations being done to allow for surgeries to be to have mobile hospitals and mobile healthcare clinics to move around and get healthcare to the rest of the country. However, they started thinking about this problem and started something called Ayushman Bharat Health Infrastructure. So while we are growing the hospital infrastructure, remember there's also the Ayushman Health Infrastructure, which is rural healthcare and health and wellness centers that are going to be developed. And I think they've also gotten approval from the WHO for Ayushman treatments. So these are approved treatments in traditional medication that work on increasing your immunity, reduce obesity, reduce heart disease, reduce lung disease and stuff like that, just by bringing back healthy living standards. Now, this is a very important slide. And whenever I advise foreign companies, particularly SMEs, on coming into India, I encourage them to look very, very closely at this. So everything that I told you about Gati Shakti and the National Logistics Plan and all of that stuff, you see it here. So on the left, you see the number of domestic airports and international airports. Now, remember, we've only highlighted the major ones. There are far more than this that could not fit on the map that are there in India. But when you are planning your India entry and you are thinking of where in India you will want to set up, look at this. Ensure you are able to get your product from point A to point B and reach your ultimate customer by planning your location sensibly. So you've got the seaports, you've got the airports on the map on the left, and that is kind of mapped to each of our cities, each of our states and cities. On the right is the infrastructure projects that I was telling you about. So you've got your industrial corridors, which are the orangey lines. So as you can see, they really connect you north to south. And remember that these are dedicated freight corridors. These are high-speed expressways that are being set up. Over here, the blue lines, these are your inland waterway projects and your national waterway projects. You've got the bullet train routes that are being set up. You've also got the future projects. So the dotted lines are the projects that have been planned but have not yet been commissioned, or the major ones that are under commissioning right now. You'll see improvements over here as well in the Northeast. Something that you may or may not know about, and we actively chose not to put it on this map, is an alternative trade route that is being created here, where we have agreements with Myanmar, and we are now going to be bypassing the Chicken's Neck here because of geopolitical risks. and looking at moving product over here. So that is why this particular section is extremely important in, the whole of the East Coast is very important in developing the logistics nodes, because now we can bypass the chicken's neck here and we can go directly around Bangladesh through Myanmar and get into the northeast of the country. And construction is ongoing right now. Going forward, based on everything that I've said, these are the sectors. And you're going to say, yes, it covers everything. And I will agree with you. It covers everything because 1.4 billion, 1.5 billion people, a majority of them now have electricity, they have broadband, they have fresh water, they have gas for cooking, which means that they have free time. They are setting up cottage industries. They are getting new jobs with Make in India, with these construction projects. Landless labor are also getting jobs. There are a huge number of agri projects there to increase incomes in the hands of farmers. And what all of that means is disposable incomes and aspirations are growing, which means purchasing power is growing, which means you would be amazed to see the amount of rooftop solar projects that are there in rural India. Take it from me, it is much more than you would see in urban India. Aviation, huge number of ports, space technologies, huge number of plans, not just for launch vehicles, for the launching side of it, the upstream part of it, the downstream part of it, sorry, but also in the upstream part of it, satellite requirements, earth imaging requirements, environmental checks and stuff like that. There's a huge demand across the entire satellite chain. And remember that this has now been privatized. Defense manufacturing, automobiles, I don't need to tell you any more about this because these have been growing sectors for a long time. And right now they are continuing to grow because there's all this impetus of government infrastructure investments, etc., that are now pushing it even further forward. So if you are planning on coming into India, you basically have three ways of doing it. You'd have greenfield, you'd have brownfield or mergers and acquisitions, or a joint venture. Each of them have their pros and cons. So if you're doing a greenfield, yes, it's a clean start. You have complete control. So if you've got IP and stuff like that, you want to protect it, you want to do greenfield. However, higher investment commitments, long gestation period. You have to build, there's a learning curve for you to understand what the local situation is like for you. And of course, creating a distribution network, if you don't have people on the ground, if you don't have that understanding on the ground, then that's a bit tricky. Mergers and acquisitions, lots of benefits. Problems are there could be some hidden surprises. It's really essential that you do really good due diligence. In our case, we often take this down to forensic audits and very deep checks, to the extent of checking if there are criminal cases against the party that our client wants to acquire. The final bit is post-acquisition integration. I cannot stress how important it is that the post-acquisition integration is managed properly on accounts, on finance, on auditing systems, everything. If you want the acquisition to run properly or the merger to run properly, you have to ensure that all of your systems are aligned with each other. Joint ventures, you have less freedom. It's kind of a hybrid between the two, less freedom as compared to 100% subsidiary. Exits are relatively difficult because it's more of, you have to get along with your partner. You have to get your partner to agree to it. Safety of the company's IP, a little bit iffy if the relationship between the two joint venture partners is not that strong. And I'll go into that later on. But otherwise, a lot of companies come into India using the joint venture route. So long story short, we have different structuring options for India. So if you were evaluating how to come into India, you can do a market study, you can do a specific project, or test marketing and sales. So what are your options? You don't have to set up a private limited company for that. For that, you can do a liaison office, a branch office, or a project office, as long as your parent is not in a restricted country. What is a restricted country? If you share a border with us, you are a restricted country. In that case, you have to apply to the government for clearance. The government usually gives it with certain exceptions. But if you're not from a restricted country, then you go directly through the ROC. If you're taking the plunge, So if you're moving into India with a long-term plan, you have intellectual property that you have to protect. You want to create your own distribution network. You want to manage labor matters on your own. You feel that you will do a better job than anybody else. Look at a joint venture or look at wholly owned subsidiary. So if you're not really interested in creating a distribution network on your own, you don't want to do all of that legwork and investment immediately, do a joint venture. If you want to do everything yourself because IP is so critical, do a wholly owned subsidiary. FDI limits have been opened up for almost everything except a few sectors in defense. Once again, the restricted country regulations do apply, so be careful about that. But otherwise, it's pretty simple. How do you decide? You can just go through this, but effectively, remember that liaison offices, you cannot run anything commercial through them. So that's always an issue there. It's only a communication channel. So if you want a non-resident entity, a branch office, a project office, or a liaison office, that's the way you go. Liaison office, obviously, because there's no commercial activity, there's no tax. Branch office, project office, it's a limited time duration. If you want a resident entity, which remember that first map, and if you want to get into other FTAs or rather other trade agreements that India has, you might want to consider a resident entity. An LLP or a wholly owned subsidiary are your options. Once again, separate legal entities, particularly for creating and protecting IP. These are important. You cannot do that with a liaison office or a project office. Investor exit and entry cannot be very frequent. And FDI also is permitted. You've got 100 for wholly owned subsidiaries, and this is the route that we recommend a lot of our clients take, because wholly owned subsidiaries are really one of the most convenient ways of handling things in India. You have 100% FDI in most sectors. I'm sorry, I'm rushing through a lot of these slides because we only have 45 minutes and I've realized I'm already 28 minutes in. Things to prepare before you set up. Now, this is a critical, of everything that I've said, this is the most critical slide. No matter what the FTA says, if you cannot handle your Indian partner, no FTA is going to help you grow your business in India. So understand your central and local laws that are applicable to you and your product when you are doing business in India. Develop a two-way relationship of trust and regular communication with your people on the ground. So if there is a problem, there are no delays between the time that it occurs and it gets flagged off to you. Which also means that you can sort out problems really quickly, because remember, India is a very, very dynamic and innovative market. Work out the terms of collaboration before you move product. Please don't do it based on a handshake. Please don't do it based on the fact that an employee's uncle, or rather an employee recommended an uncle who was doing this, and therefore you trust your employee, so you would move your product. Please protect yourselves. Have a very clear demarcation of shareholding, of management and board compositions, as well as roles and responsibilities. Do this in the beginning. These are all accepted ways of doing business in India. Agree upon terms for transfer, change of control, as well as terms of termination. And I cannot stress how important it is to have terms of termination in joint venture agreements, in contractual agreements, whenever you sign them anywhere. Exit procedures, dispute resolution, share valuation methodology, and share valuation methods. Please put all of that in your terms before you start moving product or services or send people on the ground. Document your responsibilities for operations, for marketing, who's going to be responsible for the customer, who's going to be responsible for compliances, who's going to be responsible for branding and marketing, manufacturing, etc., etc. Quality control is going to be whose responsibility. Set up investment deadlines. A lot of major investments fail in India because the two partners have not agreed on milestone payments, or they've not agreed on capital injections. Do not expect the government of India to pay for your project. Many projects have failed because they were based on that assumption. So plan out your capital injections, agree with your Indian partner on how much you are expecting them to put in and how much you will be bringing in. Decide on a legal jurisdiction, and finally appoint external auditors. Whatever you do, and a lot of companies that we deal with have outsourced everything to the Indian partner, who has said, yes, we can handle everything. and they've lost control of their own product and their own entity because the auditors were also under the control of the Indian partner. Always have your own auditors. Have your own auditors come in and give you an independent verification of what all is happening, an independent idea of what is going on. If you have IP, and I am assuming a lot of you will have IP, if it is very highly sensitive, set up a private limited company in India and outsource different parts of your IP to separate JVs. So let's say you're producing an engine. You can split it up. You can split up manufacturing into two or three different joint ventures. So no single Indian partner knows what goes into the making of the entire engine. So even if part of it is copied, the entire thing is not lost. Never give away control of your customer, your distribution, and your manufacturing to the same joint venture partner. As much as possible, try and split it up if you are not going to be directly involved in what is going on in India. If your IP is moderately sensitive, much easier, set up a manufacturing base with a partner or do it alone and set up a marketing base with an Indian partner. Like I said, split the customer and manufacturing as much as possible, because in India, a lot of IP innovations and IP changes are driven by the customer saying that they want certain changes to the product. So be aware of that. Now I'm going to hand over to my partner, Sunil, who is the tax expert, and he's going to take you through the key corporate tax considerations that you will have to look at when you're in India. Sunil?
Thank you, Kim. Thank you, Kim. I think by now we all understand what are the different structures whereby you could set up an entity in India. Kim, can you go back to slide 11, please? Maybe just like to give my 2.5 cents on that slide. Now, post four essential structures, four legal entities that you can set up in India. Why are they called resident entities? Why are they called non-resident entities? Essentially, there will be some contracts in India where you will be required to set up a resident entity. For example, if you are bidding into any sensitive sectors like defense or any other sector that requires the government to have to instruct you to have a setup in India, that's when you need to set up an entity which has a resident status from a foreign exchange regulations perspective, as well as income tax, corporate income tax perspective. And that's essentially a wholly owned subsidiary, a WOS, and I'm going from right to left, and the limited liability partnership. Both of these, interestingly, are managed by the same regulator. So again, that's a matter of convenience. A branch office and a project office comes very handy when you want to just test waters in India. For example, let's say you pick up a specific project, a river cleaning project or a water purification project, something that you want to sort of experiment in India. What you can essentially do is you can just set up a project office for that project. So the life of the Indian entity begins and ends with the project. It's very easy to bring in money. It's very easy to go take back your money. And there are very minimal questions that are asked. And therefore, it's a much easier, more flexible structure. But on the other hand, you are not an Indian entity, which means you may not qualify for all the projects that are available in India, especially with the government sector, where the government says that you must have Indian participation, and therefore that may not happen. A liaison office, Kim very clearly said that a liaison office, you cannot do commercial activities. Now, a liaison office typically is set up to act as a mouthpiece of the parent company. There have been entities in India, for example, large trading houses from Japan, companies like Sumitomo, companies like Mitsubishi's of the world. They have had liaison offices in India for the last 60, 70, 80 years, at least 60 years. And what has essentially happened is that these offices have played a pivotal role in encouraging the group and the supply chain in the group to forge new bonds, new entities, new joint ventures in India. These liaison offices by themselves, they don't do commercial activities, but they create an environment, an impression in India that facilitates the group to do active business development in India by making of joint ventures, setting up new technical collaborations, so on and so forth. All of this has a tax impact. All these separate entities will have a specific tax impact. Kim, slide 14 now. 15, sorry. Again, going from right to left, let's look at a liaison office, a rep office. Again, no commercial activities involved. The Indian Income Tax Corporate Tax Act very clearly says that unless there are commercial activities, and as long as you are operating within the realms of what we call as preparatory and auxiliary activities in India, we will not charge you tax. And what do you mean by preparatory and auxiliary activities? Any activities that is a subsidiary or an allied or a non-core activity for the business is a preparatory and auxiliary activity. To give you a simple example, if you are a manufacturing company and you set up a liaison office to do market research in India, that's a preparatory activity. But if you are a marketing company, if you are a market research company globally and you set up a liaison office in India to do a market research in India, then the activity in India becomes a core activity for you, and therefore you cannot say that it is a non-core activity, and therefore you will be covered under the realms of commercial activity. Project office, branch office, again, I told you the relevance of these structures. The only downside is that the upfront tax on these structures is higher than what you find in local entities. And if you look to your left, the local entities charge anywhere between 22 and 30%. 30% is a rate that is being it's on its way out. It's more between 22 and 25. So upfront you pay more tax, but again, it's your money. So the moment you earn 100 rupees in India or $100 or 100 pounds sterling in India, you pay 35, 65 is yours. You can use this money. You can take it back in the home country. Nobody asks a question. There is no tax on repatriating this money back home to the parent company. When it comes to a wholly owned subsidiary or an Indian structure, so-called Indian structure, there is a difference between an Indian company and an Indian LLP. Now, an Indian company, although it pays a lower tax upfront between 22 and 25%, as I said, this is more prevalent now. The moment you want to take this money back or you want to give this money back to the shareholders, the money remaining post payment of corporate taxes, the moment you want to pay it back to the shareholders, there is a tax that is applied on the dividends that you pay. Now, if you were to aggregate it, the overall tax in an Indian-based entity, which is a wholly owned subsidiary, will be at least 30% of tax. That can go as high as 37%. In practical terms, today between 30 to 33 or 34%. So that's the end tax or the aggregate tax that you pay, effective tax that you pay. If you were to earn money in India, pay taxes, and take the balance out of the country back to the shareholders. This is the simple basic off the cuff calculation. An LLP, on the other hand, requires you to pay a slightly higher tax upfront. And given the structure of the LLP, given that India does not tax partners when they are in a partnership, an LLP is a limited liability partnership. When the money is distributed to the partners, there is no tax to the partners. So 30% is your tax. You can take your money back home the way you want it. LLP, however, is used more in the professional sphere. So if you are a legal firm in India, if you're an accounting firm in India, if you're a consulting firm in India, you'd like to limit your liability. And therefore, LLP is more used, more appropriate structure for these kind of businesses. Wholly owned subsidiary joint ventures are more towards operational businesses where you are a brick and mortar business or an e-commerce business, any sort of trading. This is what is more appropriate to you. Next slide, please, Kim. Now, you've earned your money, you want to take it back. What sort of repatriation structures you can put into place? I'm going to talk about these repatriation techniques sort of from a very high level. Again, these are very complex issues. Each of this issue requires multiple considerations, but the most basic way that you can take your money back is by distributing dividends. I did talk about dividend tax in the previous slide. So if you have surplus in India, post-tax surplus in India, and it is available as a free reserve, you can take the entire money out of India, no questions asked. The banks are going to facilitate the payment. The payment process is automatic. You just have to fill a few forms, declare a dividend, get a CA certificate. Uh, if there is, if you are paying to a country, to a shareholder that requires a tax withholding, do the tax withholding, pay the dividend, and again, it's some money that you have paid. The downside is when you pay dividend, you are paying your surplus, which means uh, the dividend payment is not a charge on your profit and loss account. It's the money which is shareholders' money, which is a post-tax money, and therefore this is a below the line item. And there is no tax deduction that you get from the dividend distribution. Also, in the UK, there are chances that it may be taxed in your hands. However, depending upon the local tax laws of the UK, you could also be eligible for foreign earned dividends. If a dividend that you earn from an Indian subsidiary, you could be exempt, or you could find significant credit in your UK tax returns from the dividend on the dividend that you receive from India. The other main mode of taking money outside of India is, again, and I will repeat it many times in the presentation, that whenever you talk about taking money outside of India, anything that is a charge on your profit and loss, something like royalty, fee for technical services, FTS that you see here, any sort of management fee, any sort of cost contributions that you make to the parent company, everything has to be commercially substantiated before you make this move. Typically, for payments like royalties, Kim mentioned about protection of IP. Now, generally, when you talk to a joint venture partner, issue of IP, protection of IP comes up. One way you protect your IP is obviously by writing a very strong agreement, make it enforceable in both the jurisdictions, make it enforceable in a jurisdiction where you can actually go and sort of enforce the agreement. Uh, the other part, how you sort of strengthen your agreement, is by giving it a royalty payment so that the joint venture that you run understands the value that the technology or any sort of IP that you're contributing, it recognizes the value, and therefore there is an appropriate charge on the P&L of the common entity that you're running with the joint venture partner. It's very important that you have these things sorted out right at the beginning. Now, what are the elements sort of for which you can pay royalty? You can pay royalty for use of brand. Uh, there are a lot of British brands. Cadbury is a brand that charges royalty to all the subsidiaries. We know it because this is public information. Uh, they have been in the courts on multiple tax matters where the issue of royalty was discussed. So again, any brand which is registered, which commands a value, which enhances the marketability of a product that is being sold in an overseas jurisdiction can be charged for. Trademarks in a similar manner. Know-how. We've been recently dealing with a client in the UK where the know-how was relating to a very critical component that goes into defense equipment. Now, that's a proprietary technology, and for this proprietary technology, the owner of the technology is well within its right to charge for the know-how. Technical services, again, UK comes with a lot of information. One of the oil and gas clients that we were dealing with, they were exclusive service providers to some machinery that were provided by GE in the past in the oil and gas sector. They obviously were charging for the technical services. All of this, remember, is a charge on the P&L, which means this is if you are in a joint venture, this is going to be an overriding charge. So you get paid first as royalty, and the remaining profits post-tax can also be distributed by way of dividend. So again, you are getting money first by a way of royalty or technical service fee, and then the balance profit post-tax by way of dividend distribution. A similar charge could be a charge towards the cost of debt that you were to contribute in any joint venture. Again, you are permitted, subject to conditions, to contribute monies to an Indian joint venture or an Indian subsidiary by way of external commercial borrowing. External commercial borrowing will have a cost of servicing that borrowing. The cost of servicing that borrowing, to the extent permitted, it should be permitted to a large extent, but I'm sort of, I'm an advisor, I have to qualify what I say. To the extent permitted, you can pay interest on that borrowing, and this interest also, similar to royalty, is a charge on your profit and loss. Again, if you were to have all the three elements in your repatriation strategy, so you will be paid as a foreign company for your brand, trademark, technical services fee, management fee, interest, and what is remaining post-tax can be paid as dividend. So that's how the repatriation strategy works. And then, there could be stages when you decide to sort of exit the business. Exiting a business means that you want your money back, and that is the stage where you could exercise options like share buyback. Again, not very preferred, so I'm not going to go into detail, but just for you to understand that besides the normal modes of repatriation, share buyback is something that has been used historically by a lot of companies, not anymore after a recent change in law on the tax side. Kim, next slide, please. Permanent establishment. This is a subject that we generally talk about. Again, it could be very relevant to those of you who are exploring business opportunities in India by either sending your own people. So typically, companies that are registered in the UK, that are tax residents of the UK, if you were to send your management team or your servicing team to India for more than 90 days in a 12-month period, you could end up being taxable in India in the form of a permanent establishment. Now, permanent establishment is a bit of a draconian term that is used, but what it essentially means is a tax base through which jurisdiction of a foreign country or an overseas country can tax you as a business. So imagine you are sending your managerial staff in India to do some negotiations, to do some project discussions, and they end up spending more than 90 days in India. You have actually set up a permanent establishment in India, and you must report some part of your earnings on the contracts to which these visits pertain in India, and you have to pay tax on that. This is all real, and this happens in practical world. Let's say you appoint an agent in India. This agent only works for you. It could typically happen when you have a subsidiary in India. The subsidiary works exclusively for the parent. The subsidiary takes decisions for the parent. That is when you sort of attract what we call as an agency permanent establishment. Again, there are rules and regulations on how you want to manage your agency to be able to keep it out of the permanent establishment net. But again, you could be looking at a permanent establishment issue. Similarly, if you were to send your technical people in India for an installation project, for example, or an assembly project, and they end up spending more than 6 months in India, that also could invite permanent establishment in India. The moment you have a permanent establishment in India, what happens is that the income attributable to that permanent establishment is taxed at a 35% rate in India. More so, I think the problem begins at a point where you try and ask your monies from the Indian customer. The customer will ask you to submit a no PE declaration. You cannot submit a no PE declaration because you actually have, in fact, under one of these situations, you have set up a permanent establishment. And as a result, the moment you don't submit a no PE declaration, the customer has a right to withhold 35% tax, 35% plus tax on the entire consideration that they owe to you. So this can take a completely different shape. So anybody who is wanting to venture into India on their own, without a wholly owned subsidiary or a definite structure in India, must keep the permanent establishment provisions in mind. This could take a completely different term and the entire plan could go south. Last slide, Kim. A couple of hygiene issues, compliance issues. In India, we have a tax registration called the permanent account number. Now, if you want to deal with Indian entities and you want your monies in time, it is not essential, but recommended that you have a permanent account number. As I'm saying, from a transactional perspective, it's not essential, but in the long term, it's going to help you if you have a permanent account number. Get a registration in India. It's not difficult, it's not complex, and it most certainly does not lead to any sort of complications, in the subsequent times. There are no questions asked. Nobody says that you must file a tax return in India or you will start getting notices just because you have a permanent account number. Form 10F, it is a very common sort of paper that you will be asked by the Indian customer. Now, Form 10F is simple declaration of residency. So when an Indian customer pays you, let's say you've rendered services to an Indian customer, they want to pay you. But there is a tax withholding of 20% in India on the technical services that you've rendered. You are a UK company. You say we are a UK company and therefore we want to apply the lower rate of 10% that is agreed under the India-UK tax treaty. And I'm not talking to not talking about the FTA. I'm talking about the bilateral tax agreement that India has with the UK for the last 30, 40 years now. Now, in order for you to be eligible to go under the tax treaty and use the lower rate of 10%, you must submit a Form 10F to simply tell the Indian customer that, look, I am a foreign resident registered as a taxpayer in my own country. So I have an identification, I have an origin in a treaty signed country, and therefore I'm very willing to submit this Form 10F. So please grant me access to the tax treaty and use a lower rate of 10%. No PE declaration, again, I've already mentioned about it, but essentially to satisfy the Indian customer that there is no permanent establishment in India, and therefore, if the transaction demands, you should not deduct tax, or you should deduct only tax that does not apply to a permanent establishment. Just one last bit. We've only sort of paid attention or emphasized on corporate tax provisions. But India has a large federal structure. So besides corporate tax, India also has a very well-defined federal goods and services tax structure. Now, the reason it may not be very important is that under the goods and service tax regime, like it happens in the UK VAT regime, the onus of payment of tax is on the customer. So if you were to sort of offer any services to an Indian customer from the UK, it is the Indian customer who is to pay GST in India under the reverse charge mechanism and not you. So I think, Kim, that's just about my section. Back to you. Over to you.
And since we are pretty much out of time, I am going to zip through these slides. Basically, your only takeaway from this is that the tariff rates have been dropped on a lot of stuff, which is good for both Indian products coming into the UK as well as UK products going into India. So you've got benefits across sectors. This is key wins and all, but what I'd like to emphasize on is this slide. Essentially, what happens is there's this sort of halo effect whenever there's a trade agreement signed. So you will have a lot of schemes and a lot of innovations happening around them, plus a lot of investments and R&D developments that happen around that. One more thing that you need to remember is India already has trade agreements, and I know I brought this in the first slide, and I believe Mark and his team will be having another session for all of you on rules of origin. pay attention to the rules of origin, not just in the UK-India FTA, but also in the trade agreements that India has with other countries. It could well be that India could turn into your local base for Asia, basically for this side of the time zone. And that could be your launching pad. And this is what a large number of companies have done. For example, JCB, a British company, India is, their 6 factories in India currently manufacture and export to 150 different countries. It is their largest base outside of the UK. So be aware of what India also has to offer beyond the agreement that it has with just the UK. And this is the most important slide here, how to close. If you're doing a voluntary liquidation, that means you have decided to close your entity. Very simple. Takes about a year to a year and a half. Relevant for LLPs, joint ventures, wholly owned subsidiaries. Shareholders decide, and then you bring in an insolvency professional. You follow the process. There is a process, and you close down your company, your factory, whatever you need to do. If it's a compulsory liquidation, this is when you are forced to liquidate by an external party. Now, this gets a lot more complicated. The company can pass a resolution for winding up and force a liquidation. Any shareholder can demand a liquidation. The registrar of companies, if you've been non-compliant with stuff, can close you down, or rather start an application for closure. And any person authorized by the government can also do this. You have to file a petition with the tribunal, and then a liquidator is appointed by the government, and then it takes a really long regulated process that can go up to about 4 years for full closure. Essentially, what you need to do is you need to ensure that you complete all your closure formalities, especially for future applications. And this is for, in case you have an LO, a liaison office, a branch office, or a project office. We have had situations where companies have had project offices that were open for years, and they could not close it down because their tax registrations were iffy. And the tax department did not agree with what the company was saying was relevant. And that entire dispute just went on for years and years and years. The fines piled up. And finally, the company just ended up closing down everything. So please be aware of the regulatory requirements, of the compliances, and of the closure formalities, particularly if you have like a project office and you assume that you're going to have more project offices in the future. Don't mess it up by not having your stuff under control for this one. Average duration of the closure of a liaison office, branch office, or a project office is usually 6 to 9 months, provided there are no major non-compliances. If there are non-compliances, then the rule book is out the window, because then it depends on the severity of those non-compliances. And that is it. Presentation over. Mark, over to you. This is us. We're global.
Fantastic, Kim. Thank you to both yourself and to Sunil for your presentation there. What I'd like to do now is open the floor up to questions. If anybody does have any questions, please pop them into the Q&A, or if you would like to raise your hand, I've taken the restriction off microphones. So if you'd like to raise your hand, we can come to you accordingly. You can take yourself off mute and ask of the panelists today. One thing I would mention in the Q&A and also in the chat section, I've also included links to a customer survey. Now, I know everybody asks for customer surveys nowadays. You can't go anywhere without being asked, but please just take a few moments to complete the survey. It's only very quick, but each response that is completed is reviewed. We take it very seriously, our feedback. And if there is anything that we could do that would improve the service we offer, then we'll try and do that as well. So if you have just a few moments, both in the chat and in the Q&A, to complete that survey. There are no questions. It would appear that there are no questions. One of two things has happened at this point, guys. Either you've been so thorough that there couldn't possibly be any questions, or the worst, and it happens to me, I'm sure people have fallen asleep, and I'm sure it's the former and not the latter. No, I'm only joking. If there are any questions, everybody, there are obviously this, as we said right at the start. Yes, we will, Richard. Richard's asked, will we be forwarding a copy of the slide deck? Yes, Richard, you'll have that later on today in an email. There'll be links contained in there for both the recording and for the slide deck as well. So I hope that answers your question there. This is the start of a series, obviously, with the exciting news of the agreement now with the Indian FTA. There are plans. We are currently planning to put our webinars together. The first one will be the 14th of July. So for people on the call today, look out for that in the portal of events. We call it Netflix for exporters. Other providers are available, of course, but go on there and have a look and make sure you register for the session as well. And Cam says thank you for the information to the two presenters. We have a question here. I'll just very quickly ask it. It's what type of disputes have arisen between British and UK companies doing business together? I guess you mean Indian and UK companies doing business together there. That was following on from your disputes at the end, I think, Kim, wasn't it?
Yeah. Sunil, before I dive in, do you want to get involved?
Typically, disputes have, again, joint venture will have very specific disputes depending on the nature of term sheet that the partners have signed. But the disputes could be ranging from control and management in general, control and management of the brand, market positioning, disputes in terms of payment of royalties, disputes in terms of infringement of IPs. I remember we were advising a German company that almost forgot to follow up on the Indian management. They thought the Indian management is doing everything, and after 10 years, they had no IP to protect. So there have been disputes on multiple sides. Again, typical business disputes, nothing very specific to the Indian market. But so that would be my take, Kim.
Yeah, in many cases, we've seen that a lot of it comes down to miscommunications and maybe a lack of appropriate communication between the two. I have spent about 20 years managing European and UK investments into India, both corporate as well as financial. And I cannot begin to tell you the number of times I have had to sit in a meeting between two English-speaking entities, one speaking British English and one speaking Indian English. And I've had to translate what my British client was saying and not saying to what my Indian client needed answers to. So I would say in a lot of cases, it's more a lack of transparency from both fronts. Indians have a very bad habit of saying yes to everything. Yes is being polite. You need to be clear about what you are willing to bring to the table, what you are not willing to bring to the table. You need to take this market seriously because, and this is something that I warn a lot of clients. Like I have had a situation where we organized a joint venture between a British entity and an Indian entity, and this was to get into government tenders. And government tenders is a critical part of the UK FTA. And this was a defense tender. And when the defense tender came out, and the Indian partner sent a message saying, listen, there's this tender, we have 3 days to fill it in. Can you have these guys, bring this information together? And we were like, yeah, sure. The guy responsible for setting up the tender, for filling in the tender from the UK side, because this was a UK SME, and it was only the international business development director who was authorized to do all this stuff. He was on holiday. And he was on holiday in some remote mountain somewhere and was not reachable. And that tender could not get filled in. So my advice and, like types of disputes and stuff like that, be aware of what's going on the ground. Be in contact and in regular communication with your Indian partner. The Indian partner is not out to cheat you. The Indian partner, India is such an innovative and such a fast moving market. Because remember that we are the fastest growing market in the world right now. So you have Asian companies coming in, you have European companies coming in, you have US companies coming in, and you've got British companies coming in. And everyone is offering alternatives that meet the same need. So be aware of what is going on in the market. Be aware of what your Indian partner is doing. Communicate with your Indian partner to understand what are the complications on the ground, what the customer wants. Really listen. Because we've had a large number of very, very successful joint ventures. And we've had a small number of very unsuccessful joint ventures. And it usually comes down to bad communication.
Yeah, I think we'd say it all the time within the UK Exports Academy. Clarity and communication are the really, really important, none more so than in the Indian markets as well. Okay, Kim, Sunil, thanks very much for your time today. We look forward to working with you again moving forwards with our Indian program. And for everybody on the call today, once again, a call to action. Make sure that you look at the portal, make sure that you register for the sessions, make sure that you don't miss out. And we look forward to working with you moving forwards as well. Kim, Sunil, a very good afternoon to you. Thank you for your time.
Thank you
Thank you,
for this.
Mark. Thanks
Thank
so
you so
much.
much. Thanks
Bye.
everyone for
Cheers.
joining.
Thanks,
Bye.
everybody.
Bye. Bye.
Bye-bye now.